So they bought it for 200. They're financing $38,000 worth of repairs, and the home is going to be worth 290,000 here in a month or two. This loan just closed.
Someone had to ask. I'm Amy Viaclia, and this show is built on one idea that good questions asked of the right people make all the difference. Each episode, I sit down with someone who has the expertise most of us don't and ask the questions you might not know to ask. Someone had to ask, so I did. Today, we're talking about financing a house that isn't yet what you need it to be. When we started looking at homes in Kentucky, we almost went a different direction entirely. Instead of buying something finished, we considered remodeling a home to make it fit us. And when we needed to finish a basement, extend a fence, and expand a patio at a previous house, we ended up financing that work with a private loan. Not because it was the best option, but because it was the option we knew about. We had no idea rehab loans existed or whether we would have even qualified. That's the gap I want to close today. What's a rehab loan? Why does almost nobody seem to know about it? And what should a borrower ask before assuming a private loan is the only route? So, Jay, welcome back to Someone Had to Ask.
Glad to be here.
Jay Sills is a mortgage broker with Barrett Financial LLC, and I'm just really glad you are here to help us really think about this question. But before we go any further, most people have some general sense of what a construction loan is, but I don't think rehab loans are something most people even know exist. So, could you explain the difference between the two?
Sure. Okay, so a 203K loan with FHA, it's arguably the most unutilized loan out there. They've been around for a long time, but there's been some changes, and that's what grabbed my attention at the beginning of 2025. Most loan officers don't push these loans, and it's because there's more moving parts. And whenever you have more moving parts, things can go wrong. But there's been some enhancements to what's called the FHA 203K rehab loan that's called limited. There's a limited, and then there's a full 203K rehab loan. Okay, so what changed that I'm looking at, that the ones that I will look at doing, is a 203K limited. A 203K limited is basically you can borrow up to $75,000, and it was at 35,000. In 2025, they increased it to 75,000, and that's what got my attention. Before 35,000, I mean that's good, but it's lots of times that didn't cover everything that someone wants to upgrade and make repairs with. So I just, and they just at the time seemed difficult. So that's why I steered away from it, didn't even offer it. And that's why most loan officers don't even do it either, because, they could take 2 months or 3 months, or they used to close. And at the time, and you run the risk of not everybody being very happy at the end. And no loan officer wants to do that. But what's happened is with this addition to 75,000, and you don't have to have a HUD inspector. That is a big deal. A HUD inspector would have to work with the contractor. And if you have a HUD inspector and a contractor working together, I mean, that there's so much that can go wrong. And it's too much. But with this 203K limited, you can do up to 75,000 repairs, and those are all non-structural repairs. Okay. So that means you can do, like, for this last example, the couple, they're getting a deck repaired completely and stained, repairing walls, new flooring, new kitchen, bathrooms upgraded, everything. So those type of repairs are allowed. It's just you can't take out a load bearing wall. You can't do anything to the foundation. Those are structural repairs, and that's more of a construction loan. And I'll get into that a little bit in a minute. But as far as what I'm emphasizing today, the 203K limited is a great direction to go.
Wow. So previously, when it was below that $35,000 limit,
Mhm.
it was, I can see that being eaten up with a kitchen repair or just exchanging
Yeah.
out appliances and remodeling a bathroom. And those are heavy hitting items. So if you have to do
Yes.
both, a bathroom and a kitchen, or really update some things, I can see why you wouldn't really offer that because it doesn't cover what needs to be covered.
Correct. That's exactly it, and that's why I never really cared to look at this program with just at 35,000. Um, so let me give you an example of one that we just had. This is a real life example, and this was in Guston, Kentucky. The sales price, the agreed sales price on this home was 200,000, and it needed a lot of TLC. It was very distressed. But that's it. There's nothing wrong with the foundation. There's nothing wrong with the house. So this house just needed a little TLC and just repair work that's non-structural. And what they did on the bid that they received, and I can't stress this enough, is getting a licensed contractor. That's a requirement. You can't do the work yourself. You have to go find a contractor that can put a bid together and can put together the material cost and the labor cost and break it all down. If you can find a contractor that can do that, then that's the biggest hurdle of this type of loan. So in this case, the repair work came to 38,000. So now we have a sales price of 200, 38,000. So now we're at 238,000. Now that's the acquisition cost. All right. So now we have a home that you're buying for 238,000. So your payment, your down payment comes with the total acquisition cost.
Okay.
So in this case, that comes to $8,330. All right. So now you're buying a house now for 238 and getting all the repair work that you want done. So what happens from that point is we get the bid from the contractor. We request the appraisal with the bid, and the appraiser knows the type of loan we're doing. He or she knows that we're doing a rehab loan. So what they're going to do is they're going to appraise the home as is, and they're also going to appraise it with what's called the after repair value. That's the key. So we got the appraisal back, and it came back at 290. Whenever I saw that appraisal come back at 290, I literally just pushed my chair back and
Was
was
this
just like, that is
after the
this
repairs?
was well, that's what the appraiser is appraising the home, what it will appraise for when the repairs will be done.
Got it.
Okay. So they bought it for 200. They're putting 38,000, financing $38,000 worth of repairs. And the home is going to be worth 290,000 here in a month or two. This loan just closed. And they'll have it done by mid-September. Now they have an appraisal in hand, a copy that says their home is worth 290,000 with these repairs that will be done. That is a return on investment of 724.3%.
Wow.
I have these little numbers here on my cheat sheet. $56,311 of equity they opened up with this loan by putting down 8,330, the minimum. I think that's one of the best situations, and this is what this type of loan can do for anybody. And You can look, it opens up a thought of like, you know what, I'm looking around for a house and everything's 350 and above, 325 and above, 400. What, just the housing prices are high. But you can find a home that needs a little work for say maybe two and a quarter, or less. You can find a diamond in the rough. And that's the way I think of this loan program as a diamond in the rough.
Wow, that sounds so exciting. So I'm wondering, I'm wondering how complicated was it to originate? What sparked this idea? What kind of negotiation had to happen? These are a lot of questions, but I'm going in a lot of different directions here. How on point and on the same page did you and the buyers and the realtor and maybe even the sellers have to be in order to move this forward?
Yes. Okay. So the realtor, Carly, she did a fantastic job working with me and working for me, helping me with the buyers. I approved them for X amount of dollars, but they were having a hard time finding a house that fits what they're looking for, or it's too expensive. It's too much. They over the phone, they were telling me, we just don't want to go over this amount. And so they're having a hard time, because I'm going like, well, you know, you're looking at a $300,000 mortgage, and they just really didn't want to go there. And I honestly didn't anticipate this loan alone with them happening anytime soon, anyway, for a house that they're looking for. And then all of a sudden, Carly reaches out to me and said, "Hey, look at this house. The buyers are interested in this, and it just needs a little TLC." That was her words. And I looked at it, and it certainly did, but it wasn't big time structural repairs. It was just cosmetic. And okay, I mean they'll be approved for a 203K loan, a limited, but they can, if they can keep it under 75,000 on the repair work, but so the hurdles on this, I'm talking up this loan program a lot, which I should, which it's been underserved and it's not talked about enough as an option. Um, the hurdles with this. This loan took, it took 6 weeks to close. Now, the reason it took 6 weeks is because we had issues with the contractor putting the right verbiage on their bid. We went back and forth with their bid and the underwriter, and having to add more and take away. So that was the only hurdle. Everything else was very normal. It could have closed in 4 weeks had we had the contractor just put the verbiage that we're saying on the bid exactly as we're saying. And here's the thing: I've never met a contractor or builder that isn't very alpha. They do it their way because they're chief. They're in charge in their line of work. They are in charge. They do it the way they want to do it, and you know, heck, that's it. But this contractor, they finally came to seeing what we are saying, where we're coming from. We need the verbiage on here right. So that's the only big hurdle, is getting a contractor that can put material cost and labor cost. That was, for some reason, that was our issue. The underwriter was trying to figure out, I mean, what's the material cost? He doesn't have material costs on here. Where is the labor cost? And here's why: it's not to make anybody's life hard. It's because there are draws for each job that's being done, and we have to show the checks and balances of where and how much the draws are. So there's a reason for everything. There's a guideline for a reason, and that's what we have to follow. So that's the only hurdle on a 203K, is getting the contractor bid, get it that as quickly as possible.
A house that just needs TLC and might be just a little distressed could have such a return on investment. Are there guidelines or a worksheet or something that contractors could view that has the correct verbiage and how things need to be lined up to facilitate this loan process?
Yeah, oh, definitely. And I have all of that saved now for sure. The other 203Ks I did, I had a contractor that had already done these things before, so I didn't really run into this. It still took a little bit longer because this other contractor, it took him a while to get the bid together. I mean, it took him like 3 weeks just to get the bid together. But once the bid was together, he knew what he was doing. He knew he's done this before. So when he sent that information to me, it was good. So I didn't run into the verbiage problem like I did with this one. This contractor was so detailed; it was awesome. The bid he put together was great. Stanley Steamer, I didn't know Stanley Steamer does contracting work, but apparently they do over in I guess in Brandenburg, Meade County. But they do a very detailed job. It was just I think it was their software, um, how they put the bid together. So I do have a guideline that I will definitely on the next one that I do, I'll make sure and have that. This is exactly how you need to word things, how you need to word it, and so it'll help, and especially with the realtor, um, having them on their side to understanding as well, because it could be a little frustrating whenever we aren't moving. The loan's kind of stuck. And so whenever you have a realtor that understands the process, like Carly did, she did a great job. She definitely went above and beyond on helping me ex- explain this is why we need this. It's not, the loan officer sometimes can be looked at as the bad guy. We're the ones asking for all these hard things, whereas the realtor is kind of like the friend. It's like your buddy in the whole transaction. And so she facilitated like what I need and understood it and relayed it to them. Because I mean, you sees them face to face, where they don't see me face to face. So having a realtor involved that understands the 203K is absolutely key, or can be.
So let me ask about our situation. I mean, many years ago, we were looking for a house and found a beautiful home, but we just needed to finish the basement. So we went a private loan route to get everything done, buttoned up just the way we wanted it. I don't know. What are the qualification limits? Are there certain loan amounts that only qualify for the rehab? Or is this something that people could look at when maybe it's just a basement that needs to be finished in order to accommodate their size of family or something like that?
Yeah, that's a good question, because this isn't just for a distressed home. You could find a home that doesn't need any repairs, but you might want a covered patio that's going to cost 25,000 with electrical and everything that goes in to something like that. Um, so yeah, there's nothing that's holding you back other than on the limited is the dollar amount that you can borrow, and that's up to 75,000. Um, so I mean, manufactured homes are included, and as well in this single family residence, stick built homes. Um, so everything home wise is included that you could do. There's nothing that's going to hold you back if you want to do any kind of repair work. And here's the thing too, that I've heard for years. I'll pre-approve someone and they're like, well, we're good with just finding a fixer upper. We'll just fix it up over time. I kind of sigh every time I hear that, and I don't disagree. It's just like, life happens. You buy the house, you go to your job, you go to work, you have kids, there's kids involved, your whole life with me. And then getting around to adding that deck, getting around to painting, when are you going to get around to that? I mean, really, when it comes down to it, you buy the house that you want to. That's just where you want to live. Of course, you'll make minor repair work, but as far as big things, you really put it off. And you can do with this type of loan. You can go ahead and get it financed into your home and get it done within the first month that you're there. I mean, and you don't have to do it. Yeah, you're paying for it. Sure, you're financing it. But my gosh, what it's going towards is so positive, and the return on investment you'll know immediately. Because you're going to know what the value is going to be once with the repairs. That's a big thing. And like in this case, I'll say it again. They bought the house for 200. It will be worth 290,000 here in a month or two when the repairs are all done. Isn't that unbelievable? I mean, that's three and putting down the minimum of 3.5%. That I just it doesn't get any better to me, and this is why I call this like a diamond in the rough loan program.
That really is amazing because you look at it's not dollar for dollar what investment you put into the home, it's the value that you add to the home. And just another note is it has to be a licensed contractor. But other than that, you do have a
Big
lot
point.
of freedom. So for
Yes. Yeah.
someone,
You're not
yeah,
handicapped.
yeah, no, that sounds really amazing. So for someone who might be considering, you've kind of already answered some of this because that fixer-upper, what's that going to be worth really when you think about the cost of time? So someone maybe they want to do something later on down the road, but they might consider a private loan. That might be the only option that they know, but
Mhm.
now we know about this option that can roll it all in together into one mortgage payment without having these two different loans going on at the same time. No, are there any other cautions or any other points that people need to think about before they think about fixer upper or, well, we just want to borrow this amount now. We're going to do a private loan down the road. What would you say to those people?
I think it's better to do it up front. I just do. And it's because of the interest rate. I don't know. I mean, if you here's the thing, it's not a problem to go get an installment loan, go to your local bank and, apply for a loan that's, for 10,000, 20, 50, whatever the dollar amount is. I just worry about the interest rate. And why not just tie it all together with your house now whenever you're going to be under 7%? I mean, I just think that's to me, it's a no-brainer. Lots of times in the past, people would do what's called a home equity line of credit after they've built equity in the home, and you can take out a home equity line of credit as a second lien on your home, and those are great. I love HELOCs, and I think they're good. They work as like a credit card, same thing as a credit card. So home equity lines of credit are good. That would be my alternative. If you already own the home, look at a home equity line of credit because that's a fantastic option if you want to do home improvement. That is the option. That's an awesome. That's a really solid way to do it. But how many times, whenever you bought several homes, you walk through and you're like, I really like this house, but man, I really need to upgrade the kitchen. I really would do this with the bathroom. We all do that whenever we look at houses. What we would do different, how we would make it our own. And this is a way you can do that and get it done within the first couple months. Um, that's an aspect of the loan. We have to get from the contractor just basically it's a letter saying when the work will start and how long it will take. It's that simple. Like literally, I just had this contractor type it out, sign it, This is when we'll start. This is how long it'll take. That's it. Like, so there aren't really anything that's going to hold you back. Also, credit score on these. I was talking about a home equity line of credit. That's a great option, but lots of times you've got to have really good credit to be able to access the equity in your home. I mean, you need to be, definitely above 740 to reach up to 90% of the value of your home, where you could do this FHA 203K and your credit score is just has to fall in line with FHA guidelines, where we've hit on other episodes, way more lenient with credit score. So let's say 620 and above is where you need to be. So it's just I think a fantastic option. And I don't know if you're going to hit on construction loans today, but I can kind of tell you the difference there. Um,
Yeah, let's talk just briefly about construction loans because they are their own beast, but we do need to kind of differentiate them from what this rehab loan is.
yeah. So the rehab loan is an easy way to get minor repairs to up to 75,000. Construction loan, obviously, is you are building from the ground up. The big thing with a construction loan is you have to get a licensed builder that can provide paperwork about them. That's the biggest part of the loan. It's just as much as the person buying the home. We approve the borrower, but we have to approve the builder as well. It is a process, and I've never met a builder that loves to get around the paperwork. That is no snide remark to a builder, but that's not what they really want to do. They want to be on the job site building the house, making sure everything's getting done. That's what they're good at. They don't really want to fill out this paperwork that I have to send them. So that's a big, big thing to consider if you're thinking about a construction loan. There's a ton of moving parts, and the builder is the single biggest part of the construction process. They are huge. So you can't just get somebody that doesn't have a license and doesn't can't back up maybe previous jobs that they've done in the past. They need to have some experience. So most people do. Most people go through builders. That's what they do for a living, and they have all of that. So, but that is something that comes up. Can I, I've had borrowers that'll ask or say that I want to do part of the work. Nope, you can't. You can't do it. I mean, you could on the side if you want to help your builder, but we're not going to know about that. We're going to know about the builder and who he's contracting out to do the work. So that's a big thing. And one last point with the 203K. Now, the 203K, the full 203K, that's where you need the HUD consultant. That's basically like a construction loan in a way. Um, that's where you can do anything above 75,000. And will I do those loans? I don't really want to because they'll take at best 2 months. But let's go ahead and call it 3 months. No realtor really wants to do that either. I've never met one, not one, that has ever been like, oh, can you do a 203K loan? Well, yeah, I can, but nobody wants to do it because there's so many moving parts, like a construction loan. There's just a lot. And the more moving parts you have, the more that can go wrong. And that's where everybody kind of gets unhappy when things aren't on time.
So the key here, the contractor has to be licensed in all three of these scenarios.
Mhm.
And it's not one of these where I'm going to have my own person, I'm going to paint, I'm going to do all of these things. It's the contractor who they subcontract to do the work. But really, this is an amazing opportunity for especially the market now when we're looking at housing costs that are so high. And if you can find that diamond in the rough, then you're golden with these kinds of opportunities.
It's here's the thing with this couple that just closed. Like I was saying, that they opened up 56,000, a little over $56,000 in equity out of the gate by putting down $8,300. In a year or two, they could sell this house. I mean, not that they plan to, but my goodness, what if something happens? What if something, an emergency happens? They can sell this house and make, good money to sell it, or they can take equity out now after 1 year of ownership. They can maybe, refinance and get cash back for whatever. But that's a good amount that where they're starting out versus waiting years to get to 56,000 in equity. Literally years to get there. Whereas there, it's out of the gate. And this flyer, I hope this flyer that I made that I'm looking at, I hope that you can attach it to this video, because it's really good information. It's real life information. It's not anything hypothetical. So, and it's something that people should look at.
Jay, this is I one kind of loan, and we've talked about the three different types of construction, the limited and the unlimited. This
Yeah.
is great. I mean, if someone out there is weighing remodeling against buying, or someone who's already financed renovation work and is wondering if there was a better way, well, I hope this episode gave you a clearer sense of what to ask next time. If you found this conversation useful, share it with someone staring down a fixer-upper, or someone who's already knee-deep in renovation and wondering what they missed. We'll leave it there for today. Someone had to ask, so I did.